Let me start with a number that should make every homeowner over 60 pay attention. Right now, older homeowners in this country are sitting on an estimated $14 trillion in home equity. Trillion with a T. And yet, every single day, retirees are sitting in those same homes, stressing over grocery bills, skipping prescriptions, and quietly wondering how they're going to make their savings last another 15 or 20 years, while the answer might literally be sitting under their own roof. I want to tell you about a woman named Linda, 68 years old, lives just outside Tampa, Florida. Linda's husband passed away a few years back, and her retirement savings, which looked fine on paper at 62, started shrinking faster than she expected. Healthcare costs, home repairs, a car that needed replacing, it all added up. By 67, Linda was seriously considering selling her house, the same house she raised three kids in, packing up and moving in with her daughter in Georgia. She felt like she had no other options. But Linda had something most people overlook completely, and once she understood what it actually was, everything changed. Stick around, because today we're going through the home income options that almost nobody explains properly, the ones that could mean the difference between staying in your home or being forced out of it, and one of them might honestly surprise you. If you're watching this and any part of Linda's story sounds a little too familiar, do me a favor and hit that subscribe button and tap like while you're at it. I'm Jack, this is Jack Retires, and every week we go through exactly this kind of stuff: real numbers, real options, no fluff, just the things that actually help people in their 60s and 70s feel a little more in control. All right, let's get into it. Let's start with the option most people have heard of, but almost nobody understands correctly, and that's a reverse mortgage, specifically something called a HECM, which stands for Home Equity Conversion Mortgage. Here's the simplest way to think about it. If you're 62 or older and you own your home, or you've got a small mortgage left on it, a reverse mortgage lets you convert part of your home's value into cash, a lump sum, a monthly payment, or a line of credit you can draw from whenever you need it. And here's the part that surprises people the most: you don't make monthly payments on it. The loan gets repaid when you eventually sell the home, move out permanently, or pass away, usually from the sale of the home itself. For 2026, the government has actually raised the limit on how much home value can be considered for these loans to over $1.2 million, which means even people with higher value homes have more room to work with than they did just a couple years ago. Now, before you get too excited, or before alarm bells start going off in your head, because I know some of you just had a reaction to the word mortgage, let's slow down, because this is exactly where most people either get scared off for no reason or get talked into something without understanding it. A reverse mortgage isn't free money, and it's not something to take lightly. The amount you can borrow depends on your age, your home's value, and current interest rates, and the balance does grow over time since interest gets added to what you owe. But here's what most people don't realize: you're not required to take it all as a lump sum. Linda, the woman I mentioned earlier, set hers up as a line of credit. She didn't touch most of it. She just used it to cover about $600 a month, the gap between her Social Security and her actual monthly expenses. That's it. She didn't sell her house. She didn't move to Georgia. She's still in the same kitchen she's had for 30 years, and that line of credit sits there as a backup, growing slightly over time, available if she ever needs more. For Linda, that one decision was the difference between staying put and uprooting her entire life at 67. But here's a fear that I want to address head on, because it's the number one thing people worry about with reverse mortgages, and it's based on an old myth that just won't die. People think the bank can kick you out, or that your kids will inherit nothing but debt. Neither of those is true the way people imagine. As long as you live in the home, keep up with property taxes, insurance, and basic maintenance, you can stay there for the rest of your life, even if the loan balance eventually grows larger than the home's value, because these loans are insured in a way that protects you from owing more than the home is worth when it's sold. Your heirs aren't personally on the hook for the difference either. That said, This is genuinely not the right move for everyone. And if you're planning to leave your home to your kids completely free and clear, this is something you'd want to think through carefully with your family, not just figure out on your own after the fact. Now, let's talk about something completely different, something that doesn't involve any kind of loan at all, and it's an option that's quietly becoming one of the most popular moves for retirees, and that's bringing in a renter. I know, the idea of sharing your home with a stranger probably sounds uncomfortable, maybe even a little scary, but hear me out, because the way this works today isn't what it looked like 20 years ago. A lot of retirees have an extra bedroom, a finished basement, or even a small space over a garage that's basically just sitting there empty, costing money in utilities and upkeep, and generating zero income. Renting out even one room, whether it's a long term tenant or someone using a short term platform, can bring in anywhere from $500 to over $1,000 a month, depending on where you live. Think about what that does. For someone living on a fixed income, an extra $800 a month isn't just pocket money. That could be the entire difference between dipping into savings every single month or actually leaving your savings alone to keep growing. I talked to a guy, I'll call him Walter, 71 years old, lives in a three-bedroom house outside Phoenix, completely alone since his wife passed. Two of those bedrooms were just sitting there, used maybe twice a year when his grandkids visited. Walter rented one room to a younger guy working locally, someone vetted through a roommate matching service that specializes in older homeowners. Walter told me it felt strange for about 2 weeks, and then it just became normal. The extra income covered his entire utility bill and then some, and honestly, he said having someone else in the house, even just hearing another person come and go, made the place feel less lonely. That's not something you can put a dollar value on, but it's worth mentioning because running low on money in retirement isn't just a financial problem. It's often an isolation problem too, and sometimes one solution quietly fixes both. Here's another option, and this one is specifically for people who are open to a bigger change, but who maybe haven't considered just how big the upside can be. Downsizing, but done strategically, not just moving to a smaller place in the same town. If you're living in a four-bedroom house in a high cost of living area and your kids are grown and gone, that house might be worth a lot more than you think. And it might also be costing you a lot more than you realize: property taxes, heating and cooling a bunch of rooms you don't use, maintenance on a roof in a yard sized for a family of five. Selling that home and moving to a smaller place, possibly in a lower cost area, can free up a massive chunk of equity, sometimes $100,000 or more, while also cutting your monthly expenses significantly. That freed up money, if it's invested or just kept as a cushion, can completely change the math on how long your retirement savings will actually last. Now, I'm not saying everyone should pack up and move to a different state because honestly, being near your community, your doctors, your friends, your grandkids, that matters too. And money isn't the only thing that matters in retirement. But here's the fear I want to plant here, gently, because I think it's an important one. A lot of people stay in homes that are slowly draining them financially, simply out of habit or out of attachment, without ever actually running the numbers on what staying is costing them every single year. If you've never sat down and calculated what your current home actually costs you annually, taxes, insurance, utilities, maintenance, versus what a smaller, more efficient home in the same area or nearby would cost, that's worth doing, even if you end up deciding to stay exactly where you are. At least then it's a choice, not a default. Let's talk about something that almost nobody knows exists, and it's specifically for homeowners who are struggling with property taxes, which, by the way, have been climbing in a lot of states recently. Many states and counties offer property tax deferral or exemption programs specifically for seniors, sometimes called senior tax freeze programs. What this means is, depending on where you live and your income level, you might be eligible to have your property taxes frozen at their current level, reduced significantly, or in some cases deferred entirely until the home is sold, with no payments required in the meantime. The catch is, almost nobody applies for these because almost nobody knows they exist and they're not exactly advertised. I've seen situations where someone's property tax bill was cut by more than half just by filling out a form at their local county assessor's office, something that took maybe 20 minutes for a benefit that applies every single year going forward. If you're over 65 and you haven't checked whether your county or state has a senior property tax program, that's genuinely worth a phone call this week. Because depending on where you live, that could be hundreds or even thousands of dollars back in your pocket annually for doing basically nothing except asking. Let's bring this back to Linda for a second because I think her story actually wraps up everything we've covered today. Linda didn't do one big dramatic thing. She didn't sell her house. She didn't take out some giant loan. She didn't move across the country. She set up a small reverse mortgage line of credit as a safety net. She looked into her county's senior tax programs and ended up qualifying for a modest reduction she didn't know existed. And she started renting out her late husband's old workshop space to a local woodworker for a couple $100s a month. None of these things individually felt huge, but together, they took her from a place of real fear, feeling like she had to abandon her home, to a place where she actually feels more secure now than she did 3 years ago, all without selling the house her kids grew up in. Here's my honest take on all of this. Your home isn't just where you live. For most people, it's the single largest asset they own. And yet, most retirement advice treats it like it's completely separate from your finances, like it's just this fixed thing sitting there that has nothing to do with your money situation. That's backwards. If you're running low on savings, or even just worried that you might be in a few years, your home is probably one of the biggest tools you have, and it's sitting right there, mostly unused. None of the options we talked about today require drastic action, and honestly, the first step for almost all of them is just information, a phone call, a conversation, an hour of research before you make any big decisions out of fear. If this video helped you see your own home a little differently, I'd really love to hear about it in the comments. Tell me which of these options you'd actually consider, or if you've already done something like this yourself. And if you know someone, a parent, an aunt, an older neighbor who's been quietly stressing about money while sitting in a home that might be part of the solution, share this with them. It could be exactly the conversation starter they need. I'm Jack. This is Jack Retires, and I'll see you in the next one.